Indonesia's decision to place a 5% levy on cattle imports is another blow to the already embattled northern beef industry. And it's not just 5% on future sales. It's retrospective to January 1st this year, and it's on feeder and breeder cattle. One of our biggest cattle exporters is Southeast Asia Livestock Services. Dan Ryan from Seal says the tariff is the last thing the industry needed.
There is a lot of confusion at the moment. The importers in the commercial side of the business really can't tell us conclusively what the ruling is going to be. The only thing they can tell us conclusively is they're starting to get retrospective invoices for a customs duty of 5% back to January this year.
What does that amount to?
I'd say it's a significant amount of money, and some of the imports would be over millions of dollars.
That's Dan Ryan from Seals. And despite this additional piece of lead in the live export saddlebags, prices actually lifted strongly last week for one very simple reason. There are not enough cattle around at the right weight. So steers jumped 20 cents and heifers bounced 15 cents. It's a matter of making hay while the permits are still there. Meanwhile, sale yard action saw stronger prices across the board because of a 37% drop in national throughput. Widespread rain will always fizz markets, and the restockers reacted accordingly. The trade cattle price is always a yo-yo, while other categories were helped by an undertone of possible supply shortages come spring, especially for anything of quality. This left the Eastern Young Cattle Indicator firm at $3.83 a kilo. Sheep and lamb numbers were also down last week despite the first flush of new season lambs. Restocker interest was apparent, and this bumped into strong processor bidding, so our lamb and mutton indicators both recorded strong gains. Now to grains, and the mid-year rally shows no sign of easing. The question for growers now is when to sell. Market chatter points to prices holding close to current levels until the end of the year. The driver, of course, will be weather. And there's already talk of production uncertainty continuing in the US, Europe, Russia, and even Western Australia is getting a mention because of the lack of rain. Chicago prices headed north at a fast clip. There was some profit taking, but the bulls were well in control. That soybean price is the first ever close above 1,700 cents. That's close to $500 a tonne. Local futures followed Chicago, and as mentioned, there's growing concern about the WA crop, and that's heightened by the outlook for the next week or so. There's very little moisture on the way. So WA wheat for January delivery jumped $21, while East Coast wheat for the same month rose $22. Trucking prices also lifted. Wheat jumped above $300 for the first time since early last year. In July of 2012, it was actually just $250 a tonne. Canola slipped a fraction. While sorghum demand is strong, it's been 2 years since sorghum has been at this price. Sugar continues its slow bounce. Apparently the market is expecting India to change its mind about sugar exports because of the weak monsoon, and proving once again that all farming is interconnected. Because grain and oilseed prices are on the boil, acreage for cotton planting is expected to fall, thus less cotton and therefore supply concerns. So cotton firm. There's also a connection here with the Indian monsoon, and sugar is back to its highest level for several months. The wool boys are on a break. Their next auction is in a couple of weeks. And that's the Landline check on prices.